Hey traders, Jason here from Leavitt Brothers. So in this video, I'm going to talk about how at Leavitt Brothers we handle the last few weeks. Okay, so at Leavitt Brothers, we offer trading ideas, which I mostly post over the weekend, caption all the charts, give you an idea what I'm thinking. And then every day after the market closes, I post a report, and then I post an even bigger report over the weekend. But my reports are not written like a journalist would write them. They're written from the standpoint of a trader. Okay, I figure you can go to Yahoo Finance to get a summary of what happened that day. So my reports are like journal entries that I'm allowing you to read. Okay, they're me talking to myself, what's going on in the market, what's going on with my trading. It's a journal entry that I'm letting you peek in on. So what I want to talk about to you, what I want to show you today is lines and passages from reports that I wrote the last couple weeks to give you an idea of the communication that I was offering to Leavitt Brothers subscribers. And the one thing you got to ask yourself is, how would you have done the last few weeks if you had access to these comments? Okay, again, this is like a journal entry, and I let my subscribers read them. So what I'm going to do is I'm going to go through starting early-ish in July, and you can get a sense of what I was thinking, what I was feeling, what I was planning on doing. All right, let's go through it. No charts here, just all text. All right, so July 7th, I noted the S&P and NASDAQ posted a solid gain while the small caps declined. In some cases, there was improvement with the internals, but most of the breadth readings were flat or down. So I'm already starting to note that the internals were starting to weaken. This has been the case for most of the last 4 to 6 weeks. The market presses higher, but participation is not great. The lesson we've been told is to keep going despite the divergences. Okay, be in the right stocks. That's it. Be in the right stocks. Some stocks are doing incredibly well, while others are going nowhere. If you're in the right stuff, you're doing great. This is always the case, but it's even more important because a rising tide is not raising all ships. So I was making a point that overall the market was doing great, but beneath the surface, internals were starting to weaken, and it was really important to be in the right stocks because a rising tide was not raising all ships. You couldn't just blindly buy anything or blindly buy 5 or 6 or 7 stocks and assume you're going to make money. You had to be in the right stocks. Okay, very next day, we need to keep moving forward regardless of the warnings. We need to be responsible. We can't be careless. But we can't just shut it down. Shut it down meaning shut down our trading operations. We can't just shut it down just because the market is top heavy. This type of condition can't last in the long run, but it can certainly persist in the near term. So I was noting that the market was moving up, but a lot of the gains were due to semiconductor stocks and the Mag 7, quote unquote Mag 7 stocks, and there was a lot of stocks beneath the surface that were not participating. And I noted that this can't last in the long run, but in the near term it can last, and we need to keep going. Semiconductors were doing great, most software stocks were doing great, and we needed to keep going despite the warnings. Okay, next day, a rising tide is not raising all ships. A falling tide is not sinking all ships. So I was noting and hinting at the fact that this was a stock picker's market. We got to be in the right stuff. Okay, next day, July 10th, it's a stock picker's market. Stick with what's working and don't be loyal to anything. Don't be loyal to anything means if you just made money on a stock over the previous 2 weeks, if it stops, if it reverses, get out, okay? Don't be loyal to it. Just because it paid you nicely in the past doesn't mean you should stick with it. And then the next day, play the leaders with stops in place. Ride a trend for all it's worth, and then exit when the tide turns. It's easy to say but hard to do because we either want more or we want what we just had the day before. Don't give back. Don't give too much back, okay? You want to play the next rally from your account's high water mark, not from a depressed state. Okay, so this is me. Again, my reports are essentially like journal entries that I'm letting everyone read. Okay, and I'm talking to myself here. Play the leaders. Don't be loyal to them. As soon as they reverse, get out. Okay, you don't want to give too much back and then have to ride the next rally from a depressed, with your account being at a lower rate. You want to play the next rally from your high water mark. All right, a week later, the market has changed. It's not forgiving. Instead of stocks breaking out and running or drifting up, they aren't going far before being pushed back into their patterns. Stocks that moved last week had a great tailwind. Stocks that break out now have an immediate headwind. Okay, recognizing the changing conditions is a must. Traders get themselves in trouble when the market changes and they keep their heads down doing the same thing. then at the bottom of that report, we can't buy under the assumption we can just hold. A rising tide has not been raising all ships, but at least the tide was rising. Now the tide will be whipping all over the place. And given how so many semiconductors fell today, partly due to politics and partly due to ASML, we have to be cognizant of a falling tide lowering ships. Okay, so the market is changing, and I'm reminding my subscribers, you can't just keep your head down and keep doing what worked. Whatever operation you used previously in May, in June, in the beginning of July, that worked. Well, when the market changes, you have to make slight adjustments. Okay, stocks were breaking out, following through, consolidating, breaking out again. But here, as of July 18th, stocks were breaking out, moving, but they were getting slammed back down into their patterns. Okay, so you got to make slight changes in how you operate. You can't just keep doing the same thing. A couple days later, overall the market is in great shape, and I'll maintain odds favor higher prices into the end of the year. But in the near term, don't be surprised to get some volatile up and down movement. Earnings season is here. So far, there have been some big gap downs, so be careful. Long-term bias is up, short-term bias is neutral. We need to be more defensive. And then I also noted, as it pertains to our trading ideas, the new trading ideas this week are terrible. Don't force things right now. Okay, I don't try to get everyone excited about all these great opportunities. If I look at 500 charts and I don't see opportunities, I'll tell people I don't see good opportunities. This is not a great time to trade. Okay, I'm not just trying to get you pumped up thinking you can make a whole bunch of money. I'm going to call it as I see it, and if I don't think there's a lot of great trading ideas, I'm just going to tell you I don't think there are a lot of great trading ideas. We need to be a lot more careful right now. Right now, don't force things. Next day, I'm asking questions here. Again, this is part of a report. Will we get a dip like the end of May, which was short and quickly recovered, or something similar to the first half of April, which lasted 3 weeks and pulled the S&P down 6%? We don't know. I lean towards a bigger move down because there aren't many good setups to be had. Even if I was leaning up, there isn't much to get excited about anyways. The market is in great shape overall, but in the near term, I think we need to be a little defensive. You don't have to stop trading, but I do think expectations need to be kept in check. Expectations means, in May and June, you could buy thinking I can use a loose stop. I can give it some time and space. I'm going to get 30, 40, 50% moves. Those were the expectations because that's what was being offered. But as of July 22nd, stocks were moving, pausing, and then falling back. So you just take profits on the first move. You can't expect consolidation patterns to lead to a second breakout. Okay, so expectations needed to be kept in check. They needed to be changed. The next day, July 23rd, the market is a little messy right now. This is to be expected, or at least not a surprise, given the huge catch-up move from the small caps in the beginning of earnings season. There were several quick moves today and a lack of smooth price movement. I sense a little nervousness. Traders aren't sure. And then later on in the report, the quality and quantity of trading ideas ebbs and flow. There are periods where it's hard to narrow a list because so many stocks are set and ready to go, and other times where nothing is going on. And of course, there's gray area in the middle where it's a stock picker's market, so we have to pick and choose our spots. The current environment is pretty bad for swing trading. There are very few setups, and I don't trust anything for more than a couple days. And with earnings, stocks can abruptly change course. This is not a time to be a hero. We make money in bunches, and right now is not one of those periods. Don't force trades. Okay, we don't have good setups to work with. Again, this is part of a report. I write 5 reports a week. And these are the kind of notes that I'm posting for my subscribers. I'm like whispering in their ear what is going on in the market. I don't write from a position of a journalist. I write from a position of a trader who's in the arena. 2 days later, the market has become a day trader's paradise and a swing trader's nightmare. Okay, so we're getting some volatile intraday movement. S&P moves up a bunch, it moves down a bunch. Swing traders or day traders can play those swings. It's a great environment for them. But for swing traders, it was a nightmare because stocks would move up, and instead of consolidating and continuing on, they would just move up and give back. Okay, they'd break out and fall back into the pattern. We weren't getting moves that would last even a few days, let alone a few weeks. A couple days later, the market has changed. For 2 months, we could use loose stops and give positions time and space to play out. Stocks would move, consolidate, and then move again. Many stocks posted big gains. Now stocks move and then give it all back. Overall, the market is in great shape, but day to day and week to week, anything goes. We can get a few more weeks of up and down movement where there's little net change, or we can get a couple months of choppy range-bound price action. Be open-minded. Don't force yesterday's approach on a market that has changed. Bias is neutral, but this doesn't mean the market is likely to be flat. The S&P can rally or drop 100 points on any given day and then reverse the move the next day. A dominant trend does not exist. The path forward is not clear. So I was saying this before the whole Japan carry trade, that the S&P could rally or drop 100 points on any given day, and we got to be careful because the path forward is not clear and volatility is really high. This was days before the whole Japan carry trade started. Next day, the market remains a challenge. The quality of the trading ideas fell off 2 weeks ago, and this past weekend, they were only slightly better. There just aren't many charts that jump off the screen at us. There are no easy and obvious trades. The setups aren't there, and many of the stocks that are moving aren't traveling far before reversing. And then the very next day, this remains a challenging market, an unforgiving market. This isn't May anymore or June or the first 2 weeks of July. It's a different market. We were warned a few weeks ago when the quality of the trading ideas dried up. Even if we liked the market, there wasn't much to do anyways. This is a different market. The psychology has changed. Using methods that worked in May and June to trade now is just dumb. Adjustments are needed. And the next day, in the near term, the picture remains cloudy. There still aren't many good setups. Okay, so these are the notes that I was giving to Leavitt Brothers subscribers. We pretty much avoided the whole Japan carry trade sell-off because the warnings were there. We were slowly getting out of positions. We were slowly being more careful. There were ample warnings. At first I was saying, let's keep going. Just make sure, it's a stock picker's market. Let's keep going. Let's just make sure we're in the right stuff. But eventually I pretty much said like, hey, the market has changed. We got to be really careful here. So when the market sold off the last few weeks, we had plenty of warning. For any Leavitt Brothers subscribers, they mostly avoided it. And for anyone who had positions, they had a few positions with just a portion of their portfolio and stops in place. So they just, they got out as the market moved down. So these are the notes I've been passing on to Leavitt Brothers subscribers. Ask yourself, how would you have done the last few weeks, the last month, if you had me whispering in your ear with these types of notes? All right. Hope you got something out of this. Be objective. See what's there. Don't bring some sort of deep-seated bias to the market. Just see what's there. Listen to what the market is trying to tell you. Just listen to it. Okay. The market tells you stuff. It talks to you. Like, listen to what the market is telling you and just follow that, completely void of any biases that you have. All right. Hope you got something out of this, and I will see you next time.